This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Okay, this is the second lecture on the depreciation chapter in the free lecture notes. Remember, in the first lecture, I spoke about tangible, intangible assets, and it's tangible non-current assets we're concerned with for this chapter. And I gave you a little example, a simple example, just trying to explain what we mean by depreciation. This idea of reducing the value in the statement of financial position and in the statement of profit or loss, the cost of doing that each year. But I did say that there are different methods of calculating this depreciation. And as far as the exam's concerned, and in fact, in almost every company in real life, there are two standard ways. And they're mentioned at the top of the next page. One way is something called the straight line method. The other way is something called reducing balance. And you need to be happy with both ways. In the exam, both ways are likely to be tested. And so I'll deal with the two separately. There are two different ways, obviously. In this lecture, we'll look at the straight line method. When we're happy there, then, but in the next lecture, so we'll leave it for the moment, I'll go through the reducing balance method. So first of all, straight line. Now you will see further down there's a little, what you might call formula there. But rather than just talk blindly through a formula, let me explain with an example, and then you can see where the formula comes from. So look with me at example 1. Sarkans has a year end of 31st December each year. On the 1st of April 2002, he purchases a car for £12,000. So there we have a tangible non-current asset. The car is expected to last for 5 years. Now, I mentioned in the previous lecture, how do we know? We'll discuss where that 5 years might come from later. But in the exam, if it's 5 years, it's 5 years. It also says, though, that at the end of the 5 years, we expect it to have a scrap value of £2,000. Now, what we mean there, you see, is, all right, I think it'll last 5 years, but at the end of 5 years, I hardly think you're just going to throw it away. Surely, it's likely somebody will buy it, even if it's only for the spare parts. And so, that's what the scrap value is. The scrap value, we think we'll be able to sell it for £2,000 at the end of the 5 years. Another word they might use, which means the same, the scrap value, the other word is residual value. So I can use either word, but we think it'll last 5 years, and at the end of 5 years, we think we'll sell it for £2,000. Well, we're required to show the depreciation charge or expense for each of the first 3 accounting periods, and we're going to show extracts from the statement of financial position and the statement of profit or loss. Well, with straight line, what we do is this. We say the depreciation charge or expense the cost of using this car. Well, in total, how much is it costing us over its life? We pay £12,000. 5 years later, we expect we're going to sell it and get back £2,000. So if we pay 12 and then we get back 2, over the whole life, we think it's going to cost us £10,000. However, that net cost of £10,000, it's lasting for 5 years. And so the cost each year, we simply divide by the number of years, 5, which gives us £2,000 per year, PA, per annum, per year. So that's how much it's costing us each year to use the car. And just check that formula. I don't think you really need to learn it. If you understand, it becomes automatic. But the net cost, it's the original cost less the residual value, or the scrap value. So the net cost over the 5 years is 10,000. We divide by the estimated useful life. 5 years, again, 2,000 a year. So that's what it's costing us each year. Just one little thing though. Our year end is December, and we didn't buy it until the 1st of April. So in the first year, we didn't have it for 12 months. We know it's costing us 2,000 a year, but in the first year, we didn't own it for a whole year. We bought it on the 1st of April. So how many months did we own it for? April, May, June, July, August, September, October, November, December. We only had it for 9 months. And so, sensibly, surely, if it's 2,000 a year, 12 months, if in this year we only had it 9 months, we'll take 9/12 of 2,000. And 9/12 of 2,000 is 1,500. So it's 2,000 each year we own it, but if in this first year we only own it 9 months, fine, we'll only have an expense of 1,500. And so let's look how it would appear in our statements. Forget debits and credits. We'll deal with the T accounts later, but they are much less likely in the exam. Let's see what would appear in the statements at the end of each year. So, year 1. I'll show a side-by-side statement of financial position and statement of profit or loss. First of all, in the statement of financial position, it'll be under the heading, of course, non-current assets. We've got this car. We know what it originally cost. It originally cost 12,000. But because we'd owned it 9 months, we say we've used up 1,500. We subtract this depreciation of 1,500. And so the value will show in the statement of financial position. It's fallen to 10,500 depreciation. So we reduce its value, and the cost of doing that, the cost of reducing by 1,500, well, in the statement of profit and loss, under the heading expenses, we'll have depreciation expense, the cost of what we've done, 1,500. Reduce the value, the cost of doing it is an expense. Assuming we've still got the car, let's see what would happen at the end of the second year. Again, on a statement of financial position, heading non-current assets, we've got this car. It originally cost us 12, but this time we're going to subtract more. We've already subtracted 1,500, but we've now added another year. In the second year, we've added a full year. And remember, the cost for a full year is 2,000. And so, this is workings, 1,500, 2,000. We subtract another 2,000, so we subtract a total of 3,500. And its value will now go down to 8,500. It was, after the first year, it was 10,500. Subtract another 2,000. it goes down to 8,500. Now, two things. Although the final value, after the first year, it reduced by 1,500 to 10.5. After the second year, reduced by another 2,000 to 8.5. Although there's the final value, we are required to show that little breakdown, the little workings. We're required to show how much it originally cost and how much in total we've subtracted. So that is, in a sense, only workings, but you are required to show it. And the amount we subtracted, well, the first year was just 1,500, the second year another 2,000, so a total of 3,500. That 3,500 is the total depreciation. And so to avoid any confusion, we call it total depreciation, or the better word is accumulated depreciation. Accumulated depreciation. So again, I must stress the value on the statement. First year reduced by 1,500 to 10,500. Second year reduced by another 2,000, 8,500. But that bit of workings each time has to be shown either on the statement itself, which a small company will probably do. A big company, they'd probably keep those workings on a separate little note attached to the statement. However, there's a statement of financial position. What about the statement of profit or loss? Well, last year it cost us 1,500. How much is it costing us this year? This year we subtracted another 2,000. The expense in the second year, it cost us 2,000. Now just one more to make sure you've got it. What about year 3? Well, again, assuming we've still got the car, we already know it's costing us 2,000 a year. And so I'll start this time with statement of profit or loss. The cost, depreciation expense, I don't know what the T was 2,000. What about the statement of financial position? We're going to reduce its value again by another 2,000. So it'll go to 6,500. But as I said, we are required to show those workings. We have to show the original cost, which was 12. And we have to show how much in total we've now subtracted, the accumulated depreciation. Although it's probably obvious, as of last year, we'd subtracted a total of 3,500. This year, another 2,000. And so the total, we're subtracting 5,500. And of course, the value has gone down to 6,500. This little bit here we don't show, that was my workings. But there's how it would appear for each of the 3 years. Now, I'm not going to carry on. I mean, year 4, another 2,000 expense. The value would go down by another 2,000 to 4,500. If you're worried what will happen after 5 years, well, we'll worry about that later. For the moment, I'm not interested. However, that straight line, it's an equal amount each year, except, of course, in the first year, I took a fraction because we'd only had it part of a year. We'd had it 9 months, so we took 9/12. If we'd only had it 6 months, we'd take 6/12, so a half, and so on. However, before I leave straight line, although I don't think that's difficult, I hope you've got the idea, I don't know, some companies find it a bit messy. You know, just imagine we'd got 100 cars, and every year we had to go to each car and say, oh, how long have I had this car? Or this car I've had 6 months, so we'll take 6 12s. This car I've had it 9 months, we'll take 9 12s. This car I've had it all year, we'll take the whole amount. There'll be an awful lot of messing around. It's easy for one car. As I say, if you had 100, 200 cars, a bit messy. It gives someone some work to do. It's not hard, it just takes time. And some companies, in fact quite a lot of businesses, say, well, it's all a bit of a waste of time. Because remember, we're not showing a true value. We're not saying the true value is 10.5, 8.5, 6.5 and so on. And so some businesses, I say this is quite common, they have a policy and they say, our policy is to charge a full year's depreciation. In the year of purchase. Now, if you ever see that, and you're quite likely to see that in exams, because you see it in real life, it means exactly what it says. That for this question, which I'm not going to redo the whole thing, I shouldn't need, but we calculate the depreciation in the normal way, it's 2,000 a year. We then, in the first year, took a fraction because we'd only had it for 9 months. But if you ever saw our policy as a full year's charge in the year of purchase, then the first year, the depreciation expense would be 2,000. You would not take a fraction. Now, some people get very upset and say, oh, what happens if you bought it on the middle of December? It doesn't matter. If the policy is to charge a full year's depreciation in the year of purchase, it's the full amount. You don't take a fraction. If you're not told, if it doesn't say that, then you do take a fraction. As we did in the full example here, if you're not told, it says you bought it 1st of April, you do take 9 12ths, and that's called pro rata depreciation. So be clear, if the question doesn't say anything, you count the months and do what we did. But do keep your eyes open. If it ever says, you ever see that statement, then the first year you don't count the months, you take the full year. Now finally, then I will shut up. Pity you're not here, because I'm sure some of you have wanted to ask me, what happens if you buy it on the 14th of April? You know, do you count the days? Well, in real life, you could if you wanted, but people don't. In the exam, if it is pro rata, always do it to the nearest month. And in fact, in the exam, almost certainly you'll find that they always buy on the 1st of the month. Not a problem anyway. But do it to the nearest month. So, you know, if I had bought it on the 3rd of April, you'd still say, oh, 9 months. If we bought it on the 28th of April, you'd say 8 months. And they're not going to play silly tricks on you. What happens if they buy it on the 15th of April, halfway through? No. But there we are. So, a straight line, equal amount each year. I think the arithmetic's easy enough. Just watch that last bit. If that statement's there, it's the full 2,000 the first year. If that statement isn't there, then it's as we did it, you prorata. 9 months, you take 9/12. All right, well, that's the first of the two methods, straight line. In the next lecture, I'll go through the other method, which is reducing balance, but that's the next lecture.